Welcome out to the BluSky Trading Lab. This is Coach Matt, guys. We're going to be talking about the role of indicators here today, and specifically, there's lots of indicators in the market. There's a lot of different varieties of indicators in the market, literally thousands of different indicators. But the role of indicators, there's commonality in all indicators. And two of the core indicators that I like to utilize for different purposes is the MACD and the RSI. MACD, RSI, two very traditional indicators, can help you understand a couple different things from a technical perspective. Now, I got a couple questions before we get started here today in the lab. First and foremost, on a scale of 0 to 10, 0, you know nothing about indicators, and 10, you are an expert, wizard, trading savant when it comes to indicators. How would you describe yourself in your knowledge level from an indicator perspective? RQA, good. Cindy, kind of new. 6.5. I want everybody to answer here. Everybody answer. Everybody get those fingers on that keyboard and answer. You're in the Coach Matt's lab here. We all have to answer. We all participate. You, guys, when you sit back and you let everybody else do it, everybody else answering the question here hits the enter button first. They get in front of the trader. Traders have to be active, get those fingers on that keyboard, and let's participate a little bit here. The question was, Jay, is how well do you understand indicators from a 0 to 10 perspective? And as you can see, we got some newer traders here that don't have really any clue about how indicators work, and we got some veterans here that understand the role of indicators. That is every community I've ever been a part of. You have new, you have veterans, and what I've always felt, the veterans have a responsibility to the new traders. How many of you guys feel that, by the way, when you're in the BluSky Trading Lab, you're in the BluSky community, you're a veteran trader, you see newer traders join, and you want to help? I've kind of always felt that from the veteran traders of any trading community. They want to help, and you should listen to them. As a newer trader, listen to those veterans. They were in your shoes at one point. They know how to get how to overcome some of those hurdles. In this lab, I'm always going to try to teach from bringing everybody up to the same level, because I feel like if you can learn the foundational principles and if you can truly understand the role of all things technical analysis and trading is like building blocks. You build the foundation, you build on top of it, then you build on top of that, and you build on top of that. But if you miss certain components, it's like a Jenga thing. Well, the tower comes down. And so let's focus on the basics of indicators here, and then let's work into a little bit more advanced concepts. The indicators I want to talk about today are of the momentum variety, and they can be utilized from a lot of different trading systems and from a lot of different trading styles. For example, as a core swing trader, I use MACD and RSI all the time. As a day trader, I use MACD and RSI all the time. As an investor, I don't use them as much. As a trader, they're so valuable. As an investor, not as much, because you're not making those decisions all the time. These are momentum based. We should use them for that type of purpose. They're tradable signals. They're confirmation tools. The one thing I will say about both MACD and RSI and indicators in general, though, is this. You do not ever make your trading decision based on the indicator itself. Indicators, from the very creation of indicators, are used for secondary purposes. We make decisions based on price. You see it every day with Mike in that morning session. When you guys are sitting there watching Mike, he's not really doing a lot of other forms of analysis other than just the price action, because that's what you make your decisions on. You're constantly looking at price levels, momentum from a price perspective. You're making all of your decisions from a price perspective. So where do indicators play that role? Well, they play that role in the back, in kind of a little bit of a backseat role, where they're always in the picture, but you're not making trading decisions based on that. You're making those trading decisions based on price, based on breakouts, retracements, everything we've been talking about. Indicators confirm your decisions, because what indicators can do is they can give you that secondary confirmation. Yeah, can you message Coach Matt or message Mike in Discord and get a tradable answer that you can apply right then? Absolutely, but there's some lag there. So utilizing indicators is kind of like having a coach on your team saying, "Do you agree with my decision? Do you disagree with my decision?" And the indicator is going to say, "Yeah, I do agree with your decision." That's convergence. Or, "Nope, I disagree with your decision." That's divergence. And so you're constantly going to be utilizing these indicators, but they're not end-all be-all tradable signals. They are secondary confirmation tools. The two most popular indicators from a traditional perspective, and again, there's thousands of indicators, is MACD and RSI. And I've constantly felt like if you can understand the role of MACD and RSI and understand how these two oscillating indicators work, you understand how a lot of the other indicators work as well. So let's get to know MACD a little bit. MACD was created in the 1980s, and it was created by a guy by the name of George Appel. It stands for Moving Average Convergence Divergence, which means the indicator tells us, are we converging or are we diverging? And it's based on two distinct moving averages. Many algorithms use moving averages. We talked about moving averages last week, EMAs, SMAs, the role of moving averages, short-term moving averages versus intermediate versus long-term moving averages. When you understand moving averages are extremely important to the role of all markets. But moving averages also play a role specifically on these indicators. And when you're talking about MACD uses two distinct moving averages to help us understand the momentum and when momentum's coming in, when momentum's coming out, and how should that impact the way we see the environment. So it helps us understand trends like every indicator does, but what it really does is it helps us understand momentum. Is momentum slowing? Is momentum increasing? If momentum is slowing, I want to tap on the brakes. If momentum is increasing, I want to push down. I want to hammer down. Let's go out there and let's giddy up and go. MACD has two tradable signals on it. And I want everybody to type this down. The first one is called the hook. Everybody write hook and cross. Everybody write that phrase down. Hook and cross. Everybody write that down. Hook, cross. That's the signal on MACD. When you get a hook, that's the first signal. When you get the cross, that's the confirmation. The hook shows you the loss of momentum. The cross shows you the confirmation of that momentum. So when you see the MACD line cross the signal line, and I'll explain that here in just a second, that creates a tradable signal. And so on MACD, you got two signals. You got the hook, you got the cross. Now, when the cross occurs, you will also notice that crosses the histogram, because the histogram, these bars here, the red and green bars, that's called the MACD histogram. What the histogram does is it's the visual representation of the momentum between the two moving averages. So as you can see, the very second, the MACD line is the blue line, the signal line is the kind of the yellowish gold line. As you see that hook here, and then you see the cross, well, as it hooked, MACD starts to go back to zero. That shows you that the bears are losing momentum. When the histogram starts inching its way to zero, whoever had control going into it is now losing momentum. They're losing the momentum on the hook. So the bears are losing momentum on the hook, but that's not bullish momentum. That's bears losing momentum. And I want to be very clear on this. When bears lose momentum, it doesn't mean bulls have it. And when bulls lose momentum, it does not mean bears have it. That is a common mistake and a big time mistake by newer traders when they're trying to understand these indicators. They assume simply because RSI goes above 70 that that's a shortable signal. It is not. You will lose money over time if you did that. On MACD, they assume that if they get the hook, the bears are losing momentum. That automatically equates to the bulls getting momentum. It doesn't. They are two completely distinct, different concepts. Bulls and momentum is an individual concept. Bears and momentum is an individual concept. Simply because one gets it doesn't mean the other one gives it. And because one gives it doesn't mean the other one gets it. That's not how momentum works. Bears losing momentum is simply that. Bears losing momentum. It has nothing to do with the bulls as of yet. And that is what a hook is. A hook is the indication that whoever had the momentum as the market is going down and you see that histogram coming down, obviously bears have momentum. Once we get that hook, that momentum changes. And as that momentum changes, we should be changing with it as well. Because as those things change, it creates divergence situations, which I'll talk about here in a second. So the first tradable signal on MACD is when you do the hook. And the hook is right there. That's bears losing momentum. What equals bullish momentum when it comes to MACD? What equals bullish momentum is the cross. And so the hook signifies the loss of momentum from whoever had the momentum. In this example, that would be bears had momentum. Bears are losing momentum right here. As the bears lose momentum, well, if you're a bear, you want to tap on the brakes. You should start scaling out. You should start hesitating. You should start thinking about secondary patterns. As the bears lose momentum and we get the cross, that is the tradable signal to where now the bears not only lost momentum, but the bulls have that momentum. And so when you look at it from a histogram perspective, you see the hook right here. And as it hooks, the histogram bar goes closer because what's happening on the price levels are changing and the momentum is changing. And so as you see the histogram go back up to 0 here, what's happening is the MACD line is getting closer to the signal line. And once you cross that signal line, that's when you cross back up above 0 on the histogram, which officially would equate to now bulls having momentum. So in understanding the momentum condition here, let me kind of give a little bit of Q&A here. On the hook, in this example, when we're underneath the 0 barrier and we get a hook at the low point, does that equate to bears losing momentum or does that equate to bulls gaining momentum? On the hook. Okay, man, it's not full position yet. Nope. That reminds me of Tropic Thunder. When anybody ever says full board, full speed ahead on a momentum change in the market, I'm like, you need to watch Tropic Thunder. And every time they talked about full positions, that's not what it means. It means bears are losing momentum. That's all it means. Now, if the bears are losing momentum, should that tell me something though? Maybe I should start tapping on the brakes if I'm a bear, and maybe I should start looking for bullish reversal patterns, right? It should tell us something. Just because we got a loss of momentum doesn't mean it doesn't tell us things. It tells us we need to start getting ready to giddy up and go. Now, when you get the cross, that's when the bulls officially have momentum. The hook, bears are losing. The cross, bulls are gaining. That's how you should kind of see the MACD in general. Now, when we go a little bit deeper into the conversation here, let's talk about the calculation. Now, the two moving averages here. Like we talked about last week, in moving averages, crosses are tradable signals. When the 90 MA crosses the 20 SMA, that's a tradable signal. If the 90 MA crosses on the top side, that's a buy signal. If the 90 MA crosses on the downside, that's a sell signal. Well, that's when you alone are using moving averages in your systems. MACD uses moving averages. There's two lines in MACD. The MACD line takes into account two EMAs, the 12-day and the 26-day, and that calculation combined equates to the MACD line. The signal line is the 9 EMA of the MACD line. And so the 9 EMA of the MACD line is the slower of the two. When you combine the 12 and the 26, that's a faster moving average. And in every tradable signal that uses moving averages, when a faster moving average crosses over a slower moving average, what does that represent? In every single capacity that has ever happened in any market condition, when a faster moving average crosses a slower moving average, that represents increasing momentum, is what it represents. That's why the hook and then the cross equals the momentum condition, is because faster moving averages reflect momentum more than slower moving averages do. And so when you see those faster duration moving averages, or the shorter duration moving averages cross above longer term duration moving averages, that's a tradable signal. That's basically what MACD does here, guys. It gives us that same degree of tradable signal. And so when you're looking at the calculation, the signal line is plotted with the MACD line. Now, the histogram is simply the difference between the MACD line and the signal line. That's all the histogram does, is it represents the visual difference in the momentum between the signal line and the MACD line. That's all it does. And so when you're looking at MACD, let's kind of look at a couple of these tradable signals here. When you're looking at MACD and you get the, that little too big there on that. Give me 1 second. So when you get the hook and then the eventual cross there, that signals a momentum shift. That signals a tradable setup. When you get the hook and the cross, once again, a momentum shift, and then the tradable signal. As it gets under the histogram, what do you see? Bears start having momentum here. Now, you got a hook here, right? What does that hook signify? This hook right here on the chart, what does it signify? Who's losing momentum? Bulls or bears? Right here on the MACD. Who's losing momentum? Bulls or bears? Yeah, the bears are, Riz, right? The bears are. But once again, does that equate to the bulls getting momentum? Because in this situation, did the bulls officially get momentum? No, they did not. That's why you have to understand it's not just the hook. I've seen so many traders make the buying decision based on a positive hook, and that is not the tradable signal. Now, is there ways you can front run and scale in? Yes, of course there is. Of course there is. But you can't go full position on a hook. And the reason you can't go full position on a hook is you don't have the edge. You don't have probability there. You have the hypothetical nature of probability, but you do not have it as of yet. You get that probability edge on the cross. And so do I have heartburn when a student of ours buys everything on a positive hook? Yeah, I do. Do I have that same degree of heartburn when somebody scales in on a hook? No, I do not. They're two completely distinctly different things. But it is the cross that is the actual tradable signal. Now you saw one here again. Hook, cross, got a fake out. Crossed under, came right back up. That will show you that the bulls actually have momentum. You'd get a little spooked on that one though. Hook, no cross, no momentum shift. Hook, finally a cross, a momentum shift. Starting to see the early beginnings of a hook. Maybe it crosses, maybe it doesn't. But when we see the hook, that's when we start to think momentum shift. And when that hook occurs at a key level of support on the market, that's when we start really kind of combining our skill set on the technical side of the equation versus our understanding of the MACD as well. And so once again, hook, cross. It is always the case on MACD. Hook, cross. When you hook, momentum shift. When you cross, confirmation of momentum shift. Now, crossovers, like we just talked about, are that tradable signal. That is when a bullish crossover occurs when the MACD line, i.e. the blue line in this example, hooks and crosses above the signal line. That is a bullish crossover confirmation signal. So when you're looking at this confirmation signal here and it hooks and it breaks back up, well, when I look at this from a technical perspective on the chart, I don't love that tradable signal, quite frankly. But what does it do? It puts me on the radar for a reversal here. That's what it does. I might not like the price action when we get the cross. Just because we get a cross does not mean I'm going to go out and buy right then. What it means is I need to put it on the radar for when this confirms the reversal, and then you attach yourself to the momentum. And so when you're looking at MACD and you see that cross, that doesn't necessarily mean go out there and buy. Now, if you like the tradable signal in the price and you're getting that hook and the cross simultaneously, yeah, you love that. But it doesn't always work like that. Indicators are lagging the price. And so a lot of times when we see that positive hook, we kind of get into the frame of mind that, well, we could see a little bit of reversal play out here. And so you got the hook, puts it on the radar, the cross confirms the momentum shift, and at that point, you know you're taking any tradable signal on the chart. So once again, the hook and the cross put you in a position to have the confidence to pull that trigger on any tradable signal. And Silverback, yes, it is being recorded. I will get the recording to BluSky immediately following the lab, and BluSky will put it up probably tomorrow, I would say, for anybody that had to jump out early on or whatever it is. And I appreciate that compliment there, Silver. So in terms of MACD, once again, just trying to understand that from the indicator perspective, we love these hooks and crosses, but we need to see it confirmed by the price. Remember, our decisions we make on the chart is based on the chart. The indicator confirms those decisions we see on the chart specifically. Now, let's talk a little bit about divergence. And Riz, yes, absolutely, 100%. Technical analysis is consistent on every time frame. And so when you're thinking about those day traders that use, like, for example, I was looking at some bullish divergence on a 15-minute chart here today. Oh, no, I love questions, Riz. Like, I hate lecturing. Like, I'm going to tell you right now, just the way my mind works, I love questions. I do. I love participation. I'm an educator. I'm a teacher. And true educators and true teachers embrace questions. Same. I mean, that's just, you can't say you want to teach people without saying, I want to take some questions, because you can't teach somebody without getting into the concept of some questions. And you will never interrupt me. We're here to learn. And oftentimes, if you have a question, it'll allow me to do a different case study, explain it in a different way, because I truly do believe these are building blocks. If you kind of get confused on one concept, as we start getting into more advanced concepts, all of a sudden people get even more and more confused. So never apologize for interrupting, never apologize for asking a question, never apologize for trying to get the information that you need to get to make sure that this makes sense to you and how you can navigate the market. That's why we're spending our time here, is to improve. And so I just wanted to make sure, not only to you, Riz, but everybody else, ask questions. That's why we're here. We're here to improve. We're here to grow. I'm not a lecturer. I'm not up here as a paid speaker. I'm here to teach you guys. Period, end of sentence. To teach, we got to embrace those long-form conversations and not just have that. All right. I 100% agree with that. Let's talk about divergence, because it's really divergence that stands out when you look at indicators. Indicators can confirm your decisions on charts, and they can show you divergence. And what divergence is when the indicator starts to do something that the price isn't doing. And that really speaks volumes to us traders, because that creates a pretty decent reversal environment, quite frankly. And so divergence in indicators is an important role when it comes to the backdrop of understanding reversal analysis in general. It doesn't always happen. Divergence does not always happen in every reversal. They simply can confirm the reversal. But when divergence does happen, it feels like there's some pent-up energy there, where you're going to see a little bit of a volatility explosion to the top side if you get bullish divergence. Obviously, the opposite impact on the bearish side of the equation. Now, what divergence is, once again, is when price is establishing lower levels of support, but the indicator is showing you elevated increasing areas of support. So you see this situation where it basically creates a symmetrical triangle, a symmetrical triangle environment, where you have lower lows, but you have higher lows on the indicator. That cannot continue. It simply can't. Either one, the indicator is going to give you a false read, or two, the indicator is right and the price is going to explode to the top side. And so when you're looking at bullish divergence, it happens within the backdrop of bullish reversal analysis. And so when you see a higher level of support on your indicator versus a lower level of support on your price, that shows you a bullish divergence that will most likely result in an increase in increase in price. You saw it right here, bullish divergence, price went right back up to offset the divergence. Price comes down, 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 lower lows, lower lows, lower lows. What does the indicator start to do over time? Starts to reverse. What it's showing you is momentum is shifting. And so momentum is shifting here on the chart. We might not be able to see it specifically on the price yet, but the indicator does. And because the indicator does, we want to start looking for potential reversal, a reversal formation on the asset class we're looking at. And once again, going back to Riz's question, whether you're looking at a day chart as a swing trader or you're looking at a 15-minute chart as a day trader, divergence and convergence works identical. The beautiful thing about technical analysis is it does not matter the time frame. Technical analysis is based on price action, which is based on human nature, which is basically the visual representation of how the market sees price. Well, the indicator is simply a reflection of that. And so we're seeing the momentum shift on the indicator before we're seeing the momentum shift on the price. That allows us to see it before, quite frankly, other traders do, which means we can usually get in front of whatever momentum condition is going to follow. Does that make sense, everybody, just on the understanding of the concept of divergence? Awesome. That's bullish divergence. Now, bearish divergence is the same, guys. It's just flip it upside down. It's the exact same concepts. You just got to flip the chart upside down and start thinking on the downside. What bearish divergence is when price is going up from a higher high perspective, and the highs are getting lower on the indicator. So price is going up on the higher highs, but it's going lower high on the indicator. That is showing you that price is getting held up for one reason or the other, but once it flips the script, we get a momentum condition to the downside. And so what we want to look for in this situation is the combination of one of two things. The divergence puts the reversal on the radar. The breaking of that support is the tradable signal, and the divergence confirms that tradable signal. And so divergence right here, okay, if you go back to the price here on that divergence, what was price still doing? Price was going up. On that divergence, price was trying to break out of resistance. So price was trying to break out of resistance, and yet the indicator was showing a lower level of resistance. That doesn't give a high probability for price to continue to go up when price is setting a higher level of resistance, but the indicator is showing you a lower level of resistance. It means it has less momentum going into this breakout than it did going into that breakout. And if you had less momentum going into this breakout than you did that one, and it didn't work out the last time, I don't like your odds this time either. And so when it comes to the indicator, that bearish divergence right here, that tells you shouldn't trade that breakout. That's what that bearish divergence tells you. For other traders who just focus on price, they look at that breakout and like, oh, we're good. Let's giddy up and go, 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 go. Well, really? You're overextended going into the breakout and you got bearish divergence on your MACD, probably suggests maybe a hesitation a little bit. Probably suggests don't look on the bull side of the equation. You should be looking on the bear side of the equation and either front run that breakdown or two, wait on that breakdown. And once that does, yeah, those 0 DTE puts are going to pay out there, Riz, no doubt about that. Or shorting the ES or the NQ or whatever you're trading in general. And that's once again on these indicators. I don't care what you're trading. Are you trading the currency? Are you trading a commodity? Are you trading a futures contract? Are you trading an equity? Are you trading a 0 DT option on the spiders itself? Doesn't matter to me. It all works the exact same. And so divergence can be a very powerful tool, guys, because divergence not only puts you on the radar for potential reversals, but I'll tell you right now, as a price guy, I love price action. You see that breakout right there, breaking out of a resistance area? I'm willing to bet 8 out of 10 traders take that trade, except the two who understand this indicator and the two who understand the overextended condition of price going into a potential breakout. The indicator confirms that you weren't in the environment you thought you were if the only thing you were doing was looking at price. That's the power of indicators. They give is sometimes, guys, I focus on chart, I focus on price. I'm a candlestick guy. I love price. And sometimes I look at price and I get so indoctrinated, quite frankly, with my own philosophy of price that sometimes if I don't look at something else, I will have a misread. And if I have a misread, I'm going to have a bad tradable setup because guys, I'm not looking to go into, a scalp for the next 10 minutes. I'm looking to make a trade for the next 2-3 hours as a day trader. Oftentimes, quite frankly, as a swing trader, I'm looking to make a trade for the next 3 to 5 days. As a position trader, I'm looking to make a trade, for example, on Ethereum. I've been in Ethereum now for about 2 weeks. I plan on being in it for a couple months, quite frankly, unless the data changes. And so when I'm looking to make that decision, I want to make sure that I not only have my understanding of price, I want to make sure that these indicators are confirming my read on those prices, because my read on the price is where I'm going to put that money. Where am I going to put that money to work? I want every aspect of that market working for me, not against me. And that is what MACD is. MACD, moving average convergence divergence. We utilize it for multiple different purposes: hooks and crosses and divergence. The hook, the cross signify momentum shifts. Divergence signifies reversal situations. And regardless of where you understood MACD, did this conversation help you guys out a little bit? If you're the zero, did it help you? And if you're an expert, did it help you regardless? Riz, does MACD and volume play hand in hand? Volume, no, they do not. No, they do not. Volume is a measurement of participation. That's all it is. Volume is a measurement of participation. There's certain things we want to see on volume, okay? The convergence is the hook and the cross, RQ. That's when it's converging. That's when it's confirming your decision on the chart. The divergence is what puts it on the radar, on the MACD. So going back to the original question on volume, though, volume is a measurement of participation. That is it. And that is the only thing you should see it as. There's not ever more bulls. There's not ever more bears. You cannot buy something unless somebody sells you something. So it's simply a measurement of participation. Now, we will see it through bulls and bear lenses based on what price is doing. So, for example, I'll just give you an example here is, if I'm trading a breakout, I want to see increase in volume. Okay. The reason I want to see increase in volume on the breakout is it's a momentum-based pattern. I want to see not only me, but others get involved there, right? I want to see that momentum. And so volume on breakouts, you want to see an increase in volume. Volume on pullbacks, you want to see a decrease in volume because you don't want to see institutions and hedge funds jump against you. You want to see that decrease in volume on pullbacks because that signals traders are just doing what traders do and locking in profit. And so, for example, like let's just say hypothetically, you got this, you got a nice little uptrend, and then you base here and you're going into that breakout, right? You want to see on the breakout, you want to see that increase in volume to signify that this is a momentum environment. Whereas if the market at that overextended level starts to retrace back down in terms of a pullback, you want to see a reduction in volume because that signifies that only a certain degree of traders that were trading this movement to the top side are now locking in profit to the downside. That's the reality, and that's an eye-opener for newer traders, not veteran traders. Veteran traders obviously know how that works, but it's the same traders who create the same price action on both the top side and the downside. Traders are the ones that create price. Traders are the ones that move price. Traders are the ones that do everything in the market. Investors sit on their hands for the most part. Traders trade. And so it's traders that are the ones doing all the business of the market on a day in, day out basis. It's the traders that are driving it up. It's the traders that are driving it down. What we don't want to see in that downward movement in price is increasing volume because that tells us something else is going on. A decrease in volume is just, it's standard. It's the same traders now locking in profit. So Mike was driving the NASDAQ up. Well, Mike has to lock in profit. And as Mike locks in profit, price comes down to reflect that, right? And so volume helps us understand, are we seeing a momentum condition on say breakouts or whatnot? Are we seeing profit taking? Is this institutional selling? Are the hedge funds dominating? That's kind of what the volume analysis does. It really does not play a role in terms of MACD or RSI. Now, can you create systems where you say, I need to see this on volume, I need to see this on MACD and this on price, and that three-pronged approach is my system? Of course you can. Of course you can. We tie volume into pattern development. We tie volume into breakout analysis. We tie volume into retracement analysis. But one does not have anything to do with the other because volume is simply a measurement of participation, is all it is. Great question, though. Yes, 100%. Now let's talk about RSI. RSI is probably my favorite indicator. I like MACD. I really like MACD, but I love RSI. RSI stands for Relative Strength Indicator, by the way. It was created by Wells Wilder in his great book, 1978, New Concepts of Technical Trading Systems. Most indicators, even the customized indicators that people use today, and there's a lot of them out there, even those custom indicators have some degree of creationism in the original thought of these original indicators. I don't believe there's an original thought in the market, guys. I just don't. I've been around the market too much. I've been around too many traders. I've traded too many systems. I've met too many people who just said they have the end-all be-all indicator. They might. Because it was built on the foundation that MACD and RSI created. It was built on the foundation that stochastics created. It was built on the foundation of the Schenken money flow. These 1970s and 1980s indicators are the foundation of so many different indicators out there in the market today. Other traders might have a unique take on it, and that's what separates those custom indicators and custom bots. But for the most part, kind of like the originals in most things, originals usually are a little bit better. When you're talking about RSI, RSI takes into account relative strength. It measures the upward magnitude of price versus the downward magnitude of price, and it helps you understand the momentum of that oscillator. It's an oscillator because it will oscillate between 0 and 100. And so RSI oscillates between 0 and 100, and it gives us different tradable signals. For the most part, there's 3 zones to understand on RSI. Number 1 is the oversold zone. That's right here at 30. So you see right here at 30, this line, anytime you get underneath that 30 barrier, that's an oversold indicator. You shouldn't be shorting too much into oversold conditions, the same way you shouldn't be buying too aggressively into overbought conditions. On the flip side, overbought is above 70. So oversold is when the RSI gets underneath 30. Overbought is when RSI gets above 70. Now, there's also a zone we track right here at the 50 level. And we track the 50 level for a variety of different reasons. I'll get into that here in 1 second. But those are the 3 zones that you track: 30, 50, 70. Under 30, that's oversold. Above 70 is overbought. And 50 is utilized in a variety of different scenarios. I'll talk about those here in just 1 second. Now, the calculation on RSI it's not as important as the calculation of MACD, but I still want you to understand it. RSI calculates the last 14 trading sessions, the last 14 candles, the last 14 bars, the last 14 periods you're looking at on the chart. So if you're looking at a 5-minute chart, it tracks the last 14 5-minute candles. You're looking at a daily chart, it tracks the last 14 daily candles. Same thing on the weekly. It tracks 14 data points. Now, if every single one of the last 14 candles was down, RSI would be at 0, because that's when it measures the magnitude of those levels. If the last 14 periods were all big time gains, up to the moon, well, RSI is near 100, right? Very rare to get to 100, very rare to get to 0. Okay, but that's how it is measured. Bond and Emirates, you guys got a couple questions. First, is there a time frame where it works better with MACD? No, all time frames work on the same thing. Indicator is an indicator, hooks, crosses, momentum shifts. The interpretation of the momentum is the exact same on a 5-minute chart versus a monthly chart. You don't read indicators differently based on time frames. You adjust your trading system to the time frame. So if you're looking at an RSI on a 30-minute chart, well, you're looking at either a longer-term day trade or an aggressive swing trade. It's the time frame that you're looking to hold the trade that changes. It's really not the time frame on the chart. So it works the opposite of that. Trader Bond, what's up, Bond? Good to see you. Hopefully you caught some of that overnight action on the NVIDIA tariff news. Overbought can be more bought, same with, yes, and that's what I was saying early on, is simply because something gets overbought does not mean it's a shortable situation. In fact, the opposite. It's you might not buy it because it's overbought, but it doesn't mean you're going to short it, because overbought is just that. It's representing a ton of momentum in the market. Right? And so if you're dealing with a ton of momentum in the market, you don't want to go against that momentum. Actually, the flip side is actually what you should do. You should just wait on the pullback, because if RSI gets overextended, yeah, there's been a lot of buyers and you don't want to chase that. Well, wait for the profit-taking session. If there's been so many traders that are making so much money on that move on from RSI going from 30 to 80, for example, well, I don't want to chase that. I don't want to be a bag holder. And so I'm just going to wait for those traders who have done really well in that move. Say we're looking at a 5-minute chart or a 15-minute chart, right? That's only like a 30-minute move, for example. Well, wait on the 10-minute pullback in the profit-taking session and start tracking it as a pullback situation. I'll talk about that here in just 1 second. Once again, the RSI levels of overbought and oversold are really simple to understand. Above 70 is overbought. Underneath 30 is oversold. When we get into oversold conditions, you look for bearish retracements if you're looking for a bear pattern, and you look for bullish reversal formations, W's, head and shoulders, V-shaped recoveries if you're a bull. Those are the 2 types of patterns. As a bear, you're looking for the pullback. As a bull, you're looking for a confirmation reversal type situation. Opposite, obviously, when you get overbought. Now, what does overbought signals really mean? Because again, I've said it, I think this is the fourth time I've said it in this session. I might say it another 4 times because it's that important. You cannot take one thing in the market and make it the opposite. You cannot take RSI and say it's overbought, which means it's a bear move. Those don't fit each other. It's overbought because of the momentum of the condition. It's overbought because everybody's a buyer. It doesn't mean you should be the only seller. Does that make sense, everybody? I just want to be clear on that point more than anything. Okay, so what does it really mean? Overbought really means it's a strength signal. And if you are going to go against that strength signal, you need to let the momentum play out by waiting for it to come back down underneath 70, basically. So what you do when RSI gets above 70, what you do is you look for secondary patterns. That's what you do. If RSI is overextended, do you guys remember the 1, 2, 3 pattern? The 1, 2, 3 pattern was 1, you break out, 2, you get overextended, and 3, you pull back. That's all RSI is doing here. That's all it's doing. It's confirming the 1, 2, 3 pattern. 1, you break out, 2, you're overextended, 3, you retrace. Well, RSI breaks out, momentum happens, gets overextended. What should we do? Don't chase. Wait on a better pattern. Wait on that pullback. And so when you get overextended, usually what that means is you're overextended for a reason. And if it is going to be a reversal, you're going to see that on the chart. And what I mean by that is, do you got an M formation on the chart? We all know what an M formation is. If we got an M formation and we're overbought and we're breaking the 70 barrier, that's a shortable signal. If you just have a momentum condition above 70 and you're pulling back, that's a bullish retracement, guys. And so RSI is going to work in conjunction with our technical read on the actual price of the market itself. How I read overextended conditions will tell me what the pattern is. Is the pattern simply overextended? Well, I'm going to wait on a pullback if RSI is above 70. If RSI is above 70, but we've had a short-term consolidation and we have a double top, double bottom situation and it then crosses underneath 70, that's a different pattern, guys. Not all above 70s are created equal. It depends on the pattern you see on the chart when you're above 70, and the exact same thing could be said when you're underneath 30. And so the don't is, don't make the assumption that simply because you're overbought in the short term, that automatically equates to a bearish position. It does not. The same thing with momentum on MACD. Simply because the bears gave up momentum does not mean the bulls get it. You got to see the bulls get it. Simply because you're above RSI on above 70 on RSI doesn't mean that's a bearish argument, guys. You're overextended for a reason. Bulls have been dominating the price action. Wait on better development. That's what it tells me more than anything, is when I'm above 70, I have to wait on better pattern development. I don't have enough information, and I'm just telling you how I kind of parse that information. When something's above 70, I suggest that I don't have enough information to be able to make a call on whether or not this is going to be a buyable situation or a sellable situation until I see the actual pattern development take hold when you deal with that. Because what often can happen when you do start get above 70 and you start pulling back, well, the 50 zone that I talked about, that acts as a support level, guys. And so on RSI, think about resistance at 70 and the ultimate bottom level of support at 30 and that mid-tier support level at 50. Well, oftentimes when the market starts trending back down in this pullback, well, it got right in between that 50 barrier. Right here's 50, the top level is 50, the bottom of this green bar is 40. As you can see, it kind of gets into that 40-50 barrier, and then once it hooks back up above 50, That is a tradable signal. And so when you get overextended, a lot of times traders will just wait on the pullback. And as that market does pull back, whether it's 1 day, 2 days, 3 candles, 5 candles, 7 candles, really doesn't matter. When it pulls back into that 50 barrier, we're waiting on that support bounce and then that confirmation. And so when you get above 70, once again, it's just an indication that you're overextension, and you would be expecting a secondary pattern to develop and most likely to see a pullback start to emerge. On a bearish situation, when you're in a bearish downtrend, same type of concept. As the market gets a little bit extended to the downside, market starts pulling back. Where does it pull back into? That 50 to 60 zone on the top side. Once it hooks underneath that 50 barrier, that would be another tradable signal. RSI has some really consistent divergent pattern oftentimes though, and I really like it when RSI and MACD kind of converge together and they give me the same tradable signal. When you're looking at RSI bullish divergence, once again, divergence is not going to be unique to an indicator. It's going to be consistent against most indicators. When price is doing something opposite of what the indicator is doing, that is divergence. And so when you're talking about price coming down with lower levels of support, but RSI hooking up, that shows you that you are now starting to see bullish divergence. And I want to start looking for reversal type situations. On the bearish side of the equation, price is going up, establishing higher levels of resistance, whereas the indicator is coming down. So price up, indicator down, shows you bearish reversal of formation, and when we get an overextended condition that then shows bearish divergence, that's the shortable signal. It's not just because you have it overextended above 70. It's when you're overextended, then you see bearish divergence, and then you pounce, because that is the real good Holyfield tradable signal. Now, I was looking at earlier today, we were kind of sitting in Discord, and I was looking at the ES here, and I want to show you a little bit here why I was kind of looking at and why I am still looking at a bullish reversal situation on the backdrop of the market as we go into the overnight sessions here. Now, the market had been trending bearish for pretty much since the European hours from last night. From the European Open right here, that's the London Open here. This is the Frankfurt Open right here. From the London Open on, we've been in a pretty consistent bearish downtrend. In fact, we talked about the hard 14 last week. Every time you get into that hard 14, what pushed down? Well, that 9 EMA kept pushing down. Well, what is RSI telling us right now? RSI tells us that earlier today we got overextended on that 15-minute chart. That's what it tells us. But what it's also telling us is, as that was firmly establishing a lower level of support earlier today, what was the indicator starting to do? Can anybody see that, by the way? How you got the lower levels of support, but you have the indicator start to go up. That's bullish divergence. And from that point on, you shouldn't have been looking at aggressively shorting anything, because at that point on, you didn't have a convergence situation. You had divergence. And not only that, but if you actually come out to a little bit of more time frame, you'll notice something. We're coming into some pretty important levels of support. And so as we were coming into some pretty important levels of intraday support, we started seeing divergence take hold. That's when the market started shifting its momentum today. And that's why I am now looking for a potential bullish trade going into tonight. Now, am I going to make that bullish trade just based on the indicator itself? No. The indicator itself, the divergence nature of the indicator, put it on my radar. Now I got to use my skill set as a trader to focus on the actual price action, because that's where you make your tradable decisions, is based on price. And with that said, that is how we handle the conversation of MACD and RSI. Did you guys enjoy that today? Did you guys enjoy today's lab? I told you I was going to bring it. I told you I was going to bring it. I hope you guys enjoyed that here today. As always, guys, we do this lab every single Thursday, and our goal is to build this lab to a consistent 100 people every single day. Every single Thursday. We do it every Thursday, same time, same channel. You are more than welcome, guys. Once again, thank you so much for supporting this lab. Thank you for hanging out in this lab. And I just want to say, as we conclude this lab session, I just want to say thank you for being the best part of BluSky, guys. Love hanging out with you guys. Love talking shop every single day that I'm in the afternoon session. But really, this lab, I love teaching. I love imparting the technical wisdom on other traders. And so really appreciate you guys coming out and hanging out. And with that said, I hope everybody has a wonderful, wonderful day.